Well, let me welcome you to 2025 if somebody hasn't already done that. This is our first Financial Perspectives podcast of the year, and so we're looking forward to a good year of topics and conversations with you. We hope to hear from you throughout the year. Today we thought we'd start with a what-if question. So the question is, well, what if inflation really isn't quite done? We've kind of heard that inflation, may be under control, but we've also maybe be hearing, I don't know, inflation might be kind of putting its head back up. The Federal Reserve is kind of giving some mixed signal on that. So in the back of my mind, the question I think that we all are asking a lot of times on these what if questions is, well, even if we don't expect that to happen, what if something were to happen like inflation were to take off? How would that impact my financial plan? How would it impact my portfolio? What kinds of things should I be doing in preparation for that possibility? So today, we're fortunate to have Caleb Brown with us. Caleb is a lead advisor at Foster Group, and Caleb and I have worked together for a number of years, a lot of different client situations. And I really have come to respect the way Caleb plans for people's future, the way he thinks about future spending, the way inflation might impact that, the way even just our changing and spending habits will affect things over time. So Caleb, thanks for being here today.
Yeah, thanks for having me.
So let me ask you the question just to start off. What are you hearing from people about inflation?
Yeah, I would say not hearing about inflation as much as far as like the hot topic. Mm-hmm. Maybe that was a couple years ago when we saw gas prices hitting about $5 a gallon here in Iowa. So that gets people's attention. It's the spending that you're doing every day. I would say right now what I'm hearing most about is just that the fact is everything just seems really expensive. So you're talking about going to get a house. It's like, wow, houses are way higher than what they used to be. You're going to buy a car. It's like, wow, I remember when a car was $20,000, now it's $40,000. So some of that stuff is happening. The one that reminds me every year is, it seems like Netflix, Hulu, those streaming services. I always get an email. It's like, hey, you've been increased by $1.25 or whatever it might be. It's just pretty normal stuff, but you just see it all the time. That spending and that cost just rising all the time, it seems like.
Right. Their costs are rising, but you always like the email, right? Thank you for being such a loyal customer. And just so you know, we're going to be having to raise our costs, it is true. I mean, inflation at one point a year and a half ago was touching 9%. That was a really big number. It's come down a lot since then. I think some of the things that I hear and people experience about inflation is we think when we hear inflation is coming down from 9% to 3%, let's say, we think, well, prices should come down with it. And they don't. Of course, inflation, when it levels out, it just means prices are going to stay the same. And if they haven't quite caught up, people will continue to raise prices for a while. So it impacts the way that we kind of experience our spending. So when you think about that spending projection, it's really important because as people save for the future, especially if they're thinking about retirement savings, they're planning for what that retirement is going to cost in the future could be largely impacted by inflation. So how do we work with them to make sure that there's enough money in the future, inflation adjusted, for them to have the lifestyle they're looking for?
Well, we plan for it. Yeah. Because, if you think about if inflation's happening and we feel it now, well, it'll continue on. So we just plan that we have inflation in the spending. And so what you're spending today, for instance, is a good indicator of what you might be spending in the future. So if you're retired, it's a good starting place to look at the different categories that are in there and your spending and your cash flow, and just assume that there's going to be some level of inflation going on all the way through.
Yeah. So what you're saying is that the things you're spending money on today are probably the things you'll be spending money on in the future. But those things that you're spending money on, those things are probably going to go up in price.
Yeah, we can just bank on that and plan for it.
Yeah.
That gives people peace of mind.
Yeah, kind of.
Right.
So when I think about kind of inflation, of course, we think about the CPI numbers that are kind of monitored and given to us as news information every month. There's the CPI-U, which some people just call headline inflation. CPI, the U just means urban consumers. So kind of the average person living in a community is experiencing inflation that looks like this based on an average basket of goods and services. But then there's the CPI-E.
What's the E stand for?
Yeah, well, it's getting a little closer to home. I won't say the word, but it just means people who are over 65. And so people who are over 65, they spend on things, but the kind of the balance of what they spend on maybe changes. So they're spending a greater percentage of their income on healthcare, for example, or housing. And those things have been actually experiencing an inflation rate a little bit higher than what you'd think of as the normal rate of inflation. So this kind of brings up the question as we plan for that in the future and for people's kind of experience of inflation. I know when you think about retirement planning, for example, you break that retirement into maybe 3 different sections that are going to have a kind of inflation experience, each one of their own. Give us a little background on that.
This is really interesting. So if you think about retirement into 3 phases, this is not like me coming up with this. These are words that we hear out there in the industry. It's the go-go phase, then there's the slow-go phase, then there's the no-go phase of retirement. So maybe that's 30 years, right? Mm-hmm. So that first 10 years, you have a lot more time on your hands, and you've been working your whole life, and it's like, why not go out and do some fun stuff? So we see spending a little bit more in those first 5 or 10 years. We call those the go-go years. Mm-hmm. So that's probably higher spending. And then the next phase, it starts to slow down some. People maybe aren't going to travel as much. And then that last stage, so maybe the tail end of your life, the no-go phase, you're just not traveling as much. You're not doing, you're not going a whole lot of places really. So the spending in those different phases change.
Yeah.
So as a whole, the different categories that we talked about earlier, those are still being inflated. And some of them at higher rates like Medicare, medical expenses. Another good example of that would be...
Or you mentioned like property casualty insurance.
Yeah.
So
that's a great one.
That's one that's been going up a lot faster than the regular rate of inflation.
That is a hot topic, actually. Yeah. So that one comes up a lot in client meetings. But yeah, those different inflation numbers are still there. But what's happening is, as a whole, they're changing as spending. So that's a way to sort of curb the inflation itself, is just to spend less in different categories. So if it's travel for the first 15 years, but then that dies off, well, that's a lot less money you're spending. That's the idea behind it. So the data shows that if you look at those 3 phases as a whole, you're going to spend overall a little bit less over time than you currently will if you factor in inflation. So that's just really interesting.
Yeah, it is interesting. And it kind of gives you a little hope, too, that there are some ways you can control the impacts of inflation by controlling the way that you spend. I think it's important to plan for that, though, the way you're describing it, because there's really 2 rates of spending going on. There are rates of inflation, if you will. One is kind of the technical definition of inflation. So what are the prices of goods and services? What's happening with those as measured by the government? But the other part of that is what's happening with the way that you're spending, your activity is changing to either increase or decrease the amount of money that you're spending on those things that are themselves maybe going up in price.
Right.
So super important that this is a personalized financial plan, because everybody really has some different goals in terms of what those stages look like, I expect.
Right. Yeah. If someone is maybe not as inclined to, say, travel is a big one, because that can be kind of an expensive number, and that also can be one that's inflated quite a bit. So if that's not as big of a deal in a plan, then we don't want to assume that for anybody. So part of what we do is we just understand the client. What is their goals? What's their main reason for the retirement they want to live, and then build the plan out accordingly.
Yeah, I think that's really important, that of all these things that we're talking about, they're going to affect each of us differently based on our kind of personal financial plans. And this next thing that we want to talk about is the way that we invest in light of potential inflation. And that's going to vary from person to person too, because each of us are going to have different kind of risk preferences, and that's going to influence how we invest. But when we think about how we invest for the future and inflation's impact on our investments, what are some of the things that we should be thinking about there? And I particularly wanted to talk about this idea of real rate of return.
Right. So real rate of return, what that is if you think about inflation as like the hurdle, if you will. We got to get over this hurdle. How are we going to do that? So what investment's going to give us the ability to get over the hurdle? So whether it's stocks, bonds, combination of both, historically, that's been a really good way to get over that inflation hurdle. So the real return is essentially whatever you can get from that investment portfolio, minusing out the inflation piece of it. So you're just keeping up with inflation all along the way. Yeah,
I like that. That's a great picture. If the stock market is returning on average, and really in the last 40 years, it's returned just about 11%. So since 1984, about 11% of the U.S. stock market return. Rate of inflation, same time period, has been about 3.3. So you're talking just under 8% as that real rate of return for U.S. stocks. And you can look at foreign stocks and bonds, cash. The other end of that spectrum is really cash, which has returned about 3% over that same time period. So if you've held a lot of money in cash, it's basically kept up with inflation, but it hasn't increased your purchasing power any. Of course, the big point of retirement investing is as we put money in, what we want to be doing is increasing the purchasing power of our investments versus losing ground to inflation as time goes on. The best thing I can think of here is kind of prior to the COVID period, interest rates on cash, for those of you who had money in a bank account, it was less than 1%.
Yeah.
Right. But inflation was still running at close to 2%. So even though cash might have felt safe, you're actually losing purchasing power on the cash you had parked in the bank. So Caleb, when you think about putting together a portfolio that keeps up with inflation, how do you work with a client, kind of this combination of, okay, we're going to plan for your spending, we're going to plan for a portfolio so that out in the future there are dollars available when you need them?
Yeah, that's a great question. So if you think about that real rate of return number, so I think your example was 8, let's say, and then 3%. So was that, or 8% was the overall real return. So 11 minus 3, sorry.
Yeah.
So that real return of 8, that's a pretty big number in the planning world. We wouldn't typically use that kind of number.
And that would be a 100% stock portfolio.
Right.
Which for most people, it's like that's too much risk. We don't want that much volatility, especially as we start to need money from the portfolio.
Right. So we would dummy that number down for sure. Because what we want to do there is we want to be somewhat conservative on the plan, because the what ifs of life that we just don't know, that's out there. So we always have that kind of in the back of the mind. But let's say that real return is more like 3.5% or 4%. So that tells us that's the kind of return they're going to need for the plan. So then we'll back into a portfolio based solely on their spending. So what you're going to need in retirement, we want to make sure that we're preserving some of the cash flow for those next 5 to 10 years or so, depending on the client. Build the portfolio around that, but with the idea that we've got to beat inflation still.
Yeah. And fortunately for a lot of clients, their ability to be a little more or less aggressive, they kind of have some range in that. But what is really important is picking a portfolio that you can stay with, that has at least the potential for a real rate of return that will get you your retirement spending goals, but also it kind of has protection both so you have money available when you need it, which is things like cash and bonds, but also has a degree of volatility that you can live with, so you can sleep at night.
So you stay where you're at.
You can stay invested through all different kinds of markets, because we really don't, look at 2025, we're coming off of a great 2024 and actually 2023 in terms of markets, but we don't know what 2025 is going to look like. So we have to plan as though we don't know, which means we're going to need investments that hopefully will continue to get positive rate of return. But if it's a bad year, we also need some investments that are going to provide cash if we need it, if we're looking at retirement. Well, Caleb, thanks for joining us today for our first financial perspectives of 2025. I know this is an interesting subject of inflation, but it's probably even more interesting to think about how it relates to people's futures. We know that people are wanting to plan and invest so that they're going to have the kind of financial future of independence and doing the things that they really want to do. So these are important. Thanks for doing that. We're going to be talking about a lot of other topics this year, but if you have a particular question that you'd like to hear us address, you can contact us at fostergrp.com and leave a comment or an email there, and we'll take a look at those and be happy to talk about them or respond to you. Also, if you have more interest in this inflation subject, this month on the Foster Group blog, there's going to be some articles about inflation, some graphs, some things. So if you're interested in that, please check us out there. Other than that, thanks for joining us today. We hope you have a great 2025, and we'll be talking to you soon.